welcome back. It's good to see you.
Great to see you, Scott.
You say that stocks are, quote, whispering bottom. What does that mean?
Well, I think stocks are communicating a very different message than the apparent macro that we're seeing, because it's obvious there's inflation problems. Restoration hardware is making that pretty clear, and we know the Fed's quite hawkish, and we know there's even commodity risk because of all the Russian-Ukraine war. And so I think in general we should be really cautious about the macro, but at the same time the stock market is acting far more resilient than one would expect. In fact, over the past couple of weeks, I think there have been a lot of quantitative signals that have really signaled bottom, whether it's successive 1% days or positioning. And in the past, it's always been better to listen to the market. And I think it's really whispering pretty loudly that we've bottomed.
Yeah, but I mean, whispering implies that you're not ready to yell bottom. What gets you there?
Well, I think with each day that's passing, we're a lot more confident. The glib answer is if we make new highs, then it's really validated that we've bottomed. But so far, we're above the 200-day. It looks like we've broken the downtrend. I'd love to see more strength from technology. But, Scott, I would say I think it's, our sort of view is we've probably made the low for the first half of 2022 on February 24th, which is the day of the invasion. And hopefully this all translates into the markets holding and then being very strong in the second half.
That's an interesting headline, and that's what it's going to be. We've probably made the low for the first half. I think that's what people are going to hang on. Jonathan Krinsky, who I know you know of well, put out a note this afternoon that said, quote, while we're nearing April, historically a strong month for equities, our sense is the recent rally has borrowed from some of those gains. You agree with that?
Again, yeah, I mean, there's a lot of logic to what Jonathan's saying, because, if we just think about how the next, 20 trading days will look, I don't think we're going to necessarily get positive developments because, earnings might be challenged. We're going to hear companies talk about supply chain issues and inflationary pressures. But the stock market is hanging in there pretty strongly. And I think it's because, institutional and retail investors sort of positioned for a recession in early March. And now if we don't have one, I think stocks have quite a lot of upside.
Yeah, but we're going to be on the clock the moment that the yield curve inverts, right? I mean, you know that, and that's going to start dominating the narrative. So how do we get over that hump?
The yield conversion is a big deal because we know a lot of people are watching it, and we know a lot of systems and algorithms are going to react to it. But we did put a pretty big study out on it this morning that one of the reasons why you might have to mollify or reduce how much weight you put on the yield curve is that the yield curve right now is reflecting what we call inflation backwardation, meaning if you look at the inflation curves, which looks at the tips and nominal yields, bond market yields have to reflect what the market's expecting for inflation. And the market is expecting an inflation spike in the near term, but in the out years, pretty normal inflation. That means that the sort of normal yield curve is going to be inverted, but the real yield curve is actually quite normal. That's something we highlighted in. That's very different than 06 in 2019, because at that time, the real cost of money, adjusting for inflation, actually did invert. The Fed was indeed raised rates enough that real money turned expensive short term. Today, the real cost of money in the 2-year is actually still very cheap compared to 10-year money. And I think that chart's actually is highlighting that.
Look, there are people who are clearly suggesting as well that if you're looking at the 210 spread for the yield curve, maybe you're looking in the wrong place. Leisman and others have made that point. Let's welcome in Josh Brown, obviously from halftime into the conversation, Tom. I'd like to do that. So, Josh, I mean, if you look, it's good to have you back. If you look at the rally, utilities have been doing really well. It's been very top-heavy, led by Apple and some of these other names. Does that cast any doubt over the substance of this rally, how valid, if you want to use that word, it actually is?
The rally was pretty textbook. Technically speaking, the stocks that had been beaten up the most were the ones that led the advance. I wouldn't say they bottomed first, but they definitely put on the fireworks show. And a lot of that is now being unwound. You have ARK off 4%, Peloton down 9%, Roku, Shop, Roblox, Teladoc, all the names you would expect to be the worst performers when the trend resumes, the primary trend resumes, are the worst performers. When I talk about primary trend versus counter trend, it's not jargon. The primary trend for most stocks in the market is down. Has been since last February, by the way. Most stocks, not all stocks and not the biggest stocks, but for most stocks, they peaked over a year ago and they've been in a downtrend. That the counter trend is what we just experienced over the last week, where they've been having this rock and roll rally. It's falling apart pretty quickly. You lose 3 days in 1 day. And that's very, very textbook, very typical of how a bear market rally ends. In the meantime, what's the prevailing trend? What's the real trend? WTI up 3% today. Look at the energy stocks rocking. Look at consumer discretionary underperforming. This is what the real trend is. And I would tell you one other thing.
So
it's actually not complicated. It's actually not complicated to be in this market right now. I think if you think about the VIX as like the simplest shorthand for how people are behaving, we're in a fairly well-defined range. We're in a VIX regime where whenever you see us 28, 29, get your buy list ready because that's overdone. And then when you see us down at, we hit 18.9 yesterday on the VIX. That's pretty much as good as it's gotten. And that's been the case since March 2020, this new VIX regime. So it's not that complicated. It's kind of, Judge, it's kind of like, go ahead.
I feel like we have a distinct difference of opinion here on something that's important. I've had Tom Lee just come out and suggest that the lows for the first half are in the market. And I might also suggest that a first half that he had prior described as being treacherous. And certainly he was correct. I still hear you using the term bear market rally. It sounds like you think that's what this is. And Tom Lee, do you take issue with that? Is that what this is, Tom Lee?
Well, we're in that no man's land zone where neither view can be decided, and we'll only have the answer if we make new highs. I would probably say the higher probability in our minds is we're going to make our way to new highs this year, even before the first half. So I would still view this as the market had a huge correction, priced really, more than 40% of stocks priced a pretty deep recession. And if we don't have that recession, stocks are really better to buy.
Josh, and before I let Tom go, I want your rebuttal up to that. Why is his view wrong?
I actually don't think Tom and I disagree. I'm giving you the range. I'm not saying this has to get disastrously worse, and I would never rule out us making a new high before the end of this year. Understand that stocks 3 out of 4 years finished the year up. So I don't want to give you the impression that I'm telling you it's hopeless. I'm giving you a very well-defined VIX regime that's been in place now. We're going into year 3 of this. It works pretty well. It won't work forever. But remember, we were in a 10 to 20 regime. The VIX would hang out at 10, 11. CNBC.com would write articles about how traders can't make money on Wall Street, right? Remember that? And then you would get these spikes, but the spikes would go to 20. Now it's a different game. The Fed is not on our side anymore. They're removing liquidity. They're hiking rates. They're talking about hiking rates when they're not hiking rates. So now it's 20 to 30. You saw the movie The Irishman, right? So when the guy pulls out the gun in the courtroom and points it at Al Pacino, and then his son comes running over and pulls it, what does he say? He explains. When it's, you charge when it's a gun. When it's a knife, you run, right? When the VIX is under 20, you already know that you're at the more placid end of the pool. It's not going to last long. But when you're back at 28, 29, 30, which is where we were right around March 14th, March 15th, before the Fed, that's when you have to be doing your buying. You have to buy something. So this is not about taking your portfolio to fully invested zero. It's just about being aware. This is the environment. I wish it were other, but it's not. It's not that bull market. It's not that low volatility grind higher. It is not that. It's this.
I don't know. Ed Yardeni today on the half. Tom Lee, our conclusion is that this is still a bull market. That's what he said. 5,000 to 6,000 is his range on the S&P. And this is a guy who was talking not 2 weeks ago about stagflation. Today he made the point with me on the halftime report that even if you have stagflation, that the stock market can go up in the face of that? I feel like everybody is now trying to make a more bullish case when not all that much has changed in the last couple of weeks.
Well, yeah, Scott, I mean, and I heard that interview. It was really useful. First of all, the real cost of money 10-year is still negative because 10-year inflation break-evens are higher than where the nominal is. So it should argue for PE expansion. But I think compared to 2 weeks ago, the market had a huge test because we had, I think, a lot of negative developments in headlines over the last 2 weeks. And instead of the market falling further, it was kind of revealed that people had positioned really for already a lot of this, and markets have been really resilient. So I would say it's another reason why I think the market is whispering we've already bottomed. Maybe more than whispering.
Do you see, Tom, do you see a signal in what's going on with the home builders? Because I've been spotlighting this on the show all year. These stocks, I think, are important economically, right? They're not gigantic market caps, but the ITB names, the XHB names, I think there is a signal there. And Tom, I know a lot of your bullish thesis has been predicated on household formation, demographics, and obviously when young families buy homes, it prolongs the expansion. We might have just seen the bottom in housing inventory for the cycle. And the mortgage rate, 30-year mortgage rate, has exploded in the last 6 weeks. So what's your take on whether or not we should be looking at the home builders and at all concerned with how horrific those stocks have been?
Yeah, Josh, I'd agree. Housing really punches above its weight because housing activity itself is such a huge GDP contributor. You know, every 250,000 homes is almost three-quarters of a community GDP, and every new home built creates 4 full-time job equivalents. And housing is certainly going to have to pause here because rates are rising. It's affecting affordability. And anybody in the Northeast knows that the market volatility has actually cut wealth, so people are sort of taking a pause. I do think that explains why the home builders are really weak when they should be seasonally very strong right now. But I don't know if it's a decisive proof that the consumer's turning. Because I think over the next month, we'll have a better sense of the consumer's getting weaker. But so far, they look pretty resilient.
Yeah. Tom, I got to let you go. I appreciate your time so much. And I know we'll talk to you again soon. Josh, you're going to stick with me. And I do want to drill down with you.